Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today we're going to be talking about real estate and REITs in particular. You know me, you know that I have a particular interest in real estate, particular, rental properties and things of that sort. It's kind of a side passion project, if you will. So when I went searching for somebody to talk to, I came across this article that described our next guest as the Anthony Fauci of REITs. And I knew I had to talk to him. And so I'm fortunate enough to be able to welcome Brad Thomas to Trends with Benefits. Welcome, Brad.
Great. Well, it's nice to meet you, Ed, and great to be on the show. And I will say, in regards to Anthony Fauci, I do like for my audience to sleep well at night. We call that SWAN investing. That's the acronym. So maybe that's the relevance to the Fauci comparison.
There you go. So Brad is CEO of Wide Moat Research and author of The Intelligent REIT Investor. And Brad, tell me a little bit about Wide Moat Research. You have a number of different newsletters and publications within that company, right?
Yes, we do. I started in real estate about 30 years ago. Actually, it was more of a hobby to start with. I started to write and really analyze individual stocks. And I've always had a passion for real estate. My family's been in real estate, and I had my real estate license when I was in college. I've been a real estate analyst, a REIT analyst, for really going on 10 years. And I've been a real estate investor for about 30 years. I do write a lot on a website called Seeking Alpha, which has grown to be a pretty large site. And so we've put together a number of other analysts make up Wide Moat. So not only do we cover the REIT sector or real estate space, we also have extended our coverage universe to companies, BDCs, utilities, MLPs, and midstream, as well as ordinary dividend-paying companies. So we do have a very broad coverage spectrum, but again, my specific emphasis is on real estate.
And how did you get started? I know when we talked prior, it was a pretty interesting story how you got started and just started writing and now able to earn a living.
Sure. Well, again, because of that experience I had in real estate, and of course, like investing, you're going to have some winners and losers. And fortunately, I had a fairly large number of losers going into the Great Recession. And it's because of those really difficult times, that adversity, that has really inspired me to help investors, individual investors, I might add, average Joe and average Jane, to build wealth in real estate, but recognizing that principal preservation is paramount. Having lost so much as a developer and seeing, my net worth shrink over that period of time, my passion is really rooted in helping individual investors not make those same mistakes. And real estate investment trusts really provide a terrific platform for individual investors. So you don't have to take these dangerous risks and go flip houses or do all these crazy things you see on cable TV. I think you can certainly have your cake and eat it too. You can create wealth, but also preserve the nest egg, which is really valuable for people, as you know, today.
So maybe we could talk a little bit about REITs and just kind of the basics of REITs and compare and contrast that a little bit to physical real estate. I mean, you mentioned the operational efficiencies of REITs, but then aren't there some tax benefits that you get from the physical holding of property as well, other considerations that an investor might have to think about?
Sure. Well, I guess I'll give myself a plug. I've got a book coming out soon called The Intelligent REIT Investor. I think you mentioned that. In the book, we cover a lot of that history. And I think the biggest takeaway about REITs as it relates to the business model, it is a very tax efficient model. And it simply goes back to, believe it or not, the Cigar Act. I don't know how it was in the Cigar Act of all things. A lot of people don't really recognize REITs weren't really, even though institutions do own a fair large majority of REIT shares in the United States, the law was actually created in 1960 to give, the average individual investor access to institutionally held properties. And that one law, that there's several things that qualify a company as a REIT, but that most specific one is that REITs must pay out at least 90% of their taxable income in the form of dividends. So that's why when you canvass the REIT universe and you look at dividend yields today throughout the entire spectrum, which is fairly large, we've got about close to 150 equity REITs in our coverage spectrum, not including commercial mortgage REITs or residential. But the dividend yields in the REIT space are almost double, perhaps even more than double what the average dividend paying stock is. So that's why you have a higher yield. And really that's been the attraction for a lot of retirees today, is because of those higher dividend yields that we're seeing out there. And obviously we saw even those elevate substantially in the world of COVID when we saw the sell-off and the fear that a lot of these companies were going bankrupt, which in fact they did not.
What other sector trends have you seen within equity REITs? I know there's different types of REITs. You have mortgage REITs, and then you have the equity REIT side of things. What other trends have you seen in the space?
Yeah. So again, this is really my most passionate probably question. Is there is such a large universe of coverage? I mean, I would have never imagined. Again, I was a developer, for 20 years, and I started out building little small freestanding stores for Blockbuster. Then I moved up and started to build shopping centers. And you think about real estate, and the primary kind of food groups are like multifamily, and then industrial, retail. But now you've got such an extensive categories and subcategories. Let's talk healthcare, for example. Healthcare, you can break that up into medical office buildings, skilled nursing, senior housing. I mentioned life science, even hospitals. You have one company that's a pure play, hospital landlord. And the net lease sector. Now, net lease is basically these freestanding buildings. They call them net lease because the tenant is responsible for paying the taxes and the insurance. These are freestanding buildings like Walgreens, Advance Auto Parts, FedEx warehouses. And we're seeing that universe just explode right now, Ed. I mean, we're very bullish in the net lease sector, especially now in the midst of we're in this COVID recovery stage, because these companies have long-term contractual leases. So the predictability of that income and that dividend is very, very important. So you got a lot of different types of net lease REITs. Office, I already mentioned, you got gateway and then non-gateway. Shopping centers, you've got grocery anchored, you got lifestyle, then you go to industrial, then you go to multifamily. Another category, which is fairly new to the REIT world, is campus housing. So, a lot of dormitories now they're securitized. You go to the mall sector, which has been beaten down. We can talk about that. That's a whole chapter. And then we go to self-storage. We go to data centers. We go to gaming is actually a fairly new sector, Ed, that was commenced really back a couple of years ago. It started with Vici, was one company we like, which was a spinoff of Caesars. They've grown immensely. And you've got two other gaming REITs. Single family residential, that really started thanks to the housing meltdown in 2008, 2009, private equity firms started to gobble up a lot of distressed housing. And obviously that was converted later to REITs. And we have farming, there's two farming REITs. We have cell towers, we have billboards. And of course, I don't want to forget data centers, a great place for investors these days. We call it, Ed, the trifecta, the best place to deploy capital, produces probably the best risk-adjusted returns, or what I call the three sectors of the trifecta, is data centers, cell towers, and logistics. So you have those three all connected to technology. We think that's a great place to invest capital these days.
How did some of the REITs do during COVID? Like some of the individual sectors, you talked about malls, they had gotten hit. What about commercial space in big cities like New York? Did you see weakness in those sectors?
So I guess let's start with probably the highest risk was probably lodging. And we still aren't, I'm still not quite ready to lean into the lodging yet. I mean, I just had a trip this week, took my daughter down to move to Charleston, South Carolina, stayed at a hotel for the first time in quite a while. And again, it's great to see that recovery unfold. But again, I think we're still in some early innings there. I'm hoping that there's this travel-geddon here that's going to take place. And we're starting to, I wouldn't say we're maybe starting to warm up a little bit with the hotel or the lodging sector. We spend a lot of time here at Wide Moat, Ed, looking at supply and demand, because that's one of the main things we look at in real estate, commercial real estate. And so when you look at like the theater sector, we already knew there was already way too many theaters built in the US. So we knew that there was going to be, COVID was just a rationalization, if you will, of what we already knew was too much supply in that market. Same thing for malls. There's way too many malls in the United States of America. And by the way, we've been saying this for 4 years. But now with COVID, you're seeing that acceleration of store closures, especially in the department store space, number of bankruptcies. So we're starting to see that shift. Now, I think there will be demand and will be continued demand for high quality malls as well as outlet centers. We're also pretty bullish with this Tanger Outlets, which is the only pure play outlet center REIT. We think as part of that ecosystem, that brick, that omni-channel, if you will, I think there'll still be a need for brick and mortar. I know that there'll still be a need for outlets, but we certainly know there's been too much product, and we're starting to see a lot of that flush out right now. So for a REIT, that makes it very difficult, Ed, because going back to that law that I mentioned in 1960, REITs have to pay out 90% of their taxable income in the form of dividends. So that makes it very difficult when you have a business model that's more of a value creation that requires a lot of capital for redevelopment and not very regular income payments, companies going bankrupt. That makes it very difficult. We've seen multiple bankruptcies, not many in the REIT space, but a few. CBL Properties was one. There's another one on the verge right now that we just reported on recently. But a lot of the other sectors, no sector was immune from COVID. But I mentioned those trifecta, those three technology names: data center, cell towers, and logistics. They actually went through COVID like there wasn't really any major issues. We found some really good buying opportunities. I think office is a great place today. That's why we spend a lot of time with these management teams to talk to them about, the recovery and when will New York City get back to normal? When will the Empire State Building Observatory get back to normal levels? And by the way, Tony Malkin, who's the CEO of Empire State, mentioned in the last earnings call that he says by the end of 2022, he thinks that the Empire State Building will be back to 100% normal. At any rate, but we're still pretty bullish in office. I think there was certainly some mispricing opportunities that still exist there. So we're still watching that sector very closely.
You don't think we're all going virtual and that's the end of the office now as we know it, or as we knew it?
Again, we run our own business, and it's so important to meet with people. I mean, Zoom's great. Certainly, we're going to continue to use Zoom more and more. But I guess, you're right. You got to have these, hands-on meeting and see people to make deals. And, I'm so excited to see this recovery starting to take place and more vaccines and, getting back to normal. So I definitely see a day that, we're going to see. In fact, I'll just tell you, the CEO of Boston Properties, who I spoke with this morning, I mean, he said Labor Day is really, the trigger date that he's looking for. So I think we're definitely going to see that taking place. And I can't wait to get back to New York, as well as many of these other markets that I haven't been able to go to over the last year.
Now let's talk about how you identify a quality REIT. I mean, there's so many different REITs as you kind of went through. If you're an investor, kind of where do you start or what do you look for?
Yeah, well, interesting. We have really our own proprietary kind of screening model. We call it the IQ system, which stands for intelligent quality. And so we go through a number of those fundamental attributes. Again, we're fundamental investors, not technical. And so we look at all these metrics. So starting probably with the balance sheet and a lot of those debt metrics. Liquidity is obviously extremely critical and has been through COVID-19. So I think that's, we look at the strength of that balance sheet. What are the rating agencies, S&P, Moody's, and Fitch? What are they saying? A lot of these companies aren't rated. So I think, the strength of that balance sheet, also that ties right into cost of capital. Because again, we're really in the spread business. And you think about, real estate, you invested with a certain cap rate, you have a cost of capital, and whatever's left over is your investment spread. And that's what you're going to earn on that invested capital. So we look at the cost of capital. What is the debt? What is the equity of the company overall, weighted average cost of capital? That's really a critical part. Then we look at the growth. We look at not only the historical growth, but also what is their current growth profile? And then what are analysts saying about potential growth prospects for the company? So obviously that's important. And then all of that ties right into really, I think the most important metric is the dividend. How safe is that dividend? Now, obviously in the pandemic, we've seen roughly about 70 companies that have cut, right-sized, or suspended their dividend. That's not good. That obviously doesn't help an investor sleep well at night when they see their dividend yield, drop or go to zero. So we spend a lot of time focusing on the safety of that dividend. And obviously a company that's going to be able to produce that cost of capital, have that cost of capital advantage, which by the way is important to have that scale advantage too. So having that, so you don't have one outlier that's going to sink the ship. And then we tie that into the dividend safety of that company. And what is that yield? Obviously, Ed, this, if the closer you get to a double digit yield, the less safe that company generally is. So We look for safe dividends, have healthy payout ratios. We want to see that margin of safety in that dividend payout ratio. And then last but not least, the most critical part of this, and this is the reason I titled my book, The Intelligent REIT Investor, goes back to Benjamin Graham, the intelligent investor, and that is the margin of safety. We want to buy those stocks when they're trading at a discount. We've got high quality, so we categorize and rank these companies based on quality, but we want to see that margin of safety. And we want to see a nice margin of safety because you never know what's going to happen. And we need to make sure we've got that buffer there. So all of that combined, that's really our business model. And really that's the whole premise behind my new book, The Intelligent REIT Investor.
And I see the philosophy behind your company name, Wide Moat. Do global REITs operate in the same manner as U.S. REITs, given that U.S. REITs are born of the U.S. tax code, if you will?
Yeah, so we've seen, I cover all that in my book as well. I won't give myself one more plug, I promise. But we have a whole chapter on global REIT investing, actually written by a professor at NYU who's great. But yeah, there's over 40 countries now that have REIT-like laws. That, in other words, they've copied the U.S. So we had pretty good laws set here, and I think Canada adopted pretty early. We actually started covering the India REIT market. There's I think a handful of different REITs in India now. Japan is very big over in Europe. So, there's at least 40 countries, to my knowledge, that have laws that are very similar to the U.S.
Under the new administration and going forward, I think there's been a lot of talk about an infrastructure build out and a proposal hopefully coming at some point soon. Do you have an outlook for what types of REITs might benefit under such a plan?
Yeah, for sure. Actually, I just wrote an article today on infrastructure. This was more in the midstream MLP space, but I think infrastructure is definitely going to be a huge catalyst for real property, which is kind of that umbrella way of saying in midstream MLPs, REITs. But within the REIT sector, in terms of infrastructure, probably some of the biggest names is going to be that 5G pipeline that's out there. Everybody keeps talking about the 5G, and it's there. And actually, one of the bigger names I just mentioned, American Towers, just sold off very recently. Obviously, margin of safety took the opportunity to capitalize on that. We are long AMT, American Tower, as well as their direct peer, Crown Castle. So I think the cell tower space is definitely going to be a beneficiary of infrastructure, and specifically 5G. One name that we cover a lot that's really interesting, and it's really somewhat of an outlier, is Hannon Armstrong. They've been a REIT now for maybe less than 10 years. They look really more like a utility company. They are structured as a REIT. So again, they have to pay out at least 90% of their taxable income. They're really more of what I call a sustainable income investor. So they invest in a lot of the clean energy products, the solar, wind tunnels, those types of assets. And that company has done extremely well. I'm happy to say we generated returns of over 100% during COVID-19. When they were beaten down, we backed up the truck, and perfect timing for Hannon Armstrong. And again, we saw that infrastructure beginning to grow and what that means for environmental causes. And I would say there are other sectors as well that would tie into that. Data centers obviously are going to be a big part of that 5G food chain, if you will. In terms of like direct plays, I think those are probably the best two. And then, of course, move to midstream would be in the REIT space, some of those, the way to play that infrastructure business. We
have a mortgage REIT ETF currently. And I was just kind of curious, do you have a take on mortgage REITs? Do you follow mortgage REITs as well?
We do. And we like the commercial mortgage REIT space is somewhat like a yield enhancement for building portfolios. So commercial mortgage REITs are really good because we do cover pretty much all the entire universe of real estate, commercial real estate. And of course, commercial mortgage REITs, they lend money to that space. Starwood is one of the big names out there. Blackstone is another name. Ladder Capital is another name. So commercial has been interesting because when COVID, a lot of these companies really were priced for bankruptcy. And we knew there's no way that these mortgages are going to go bankrupt. I mean, certainly the hotel sector was beaten down, and some of those companies, including Starwood, had fairly decent exposure to lodging, but we felt like they were going to be able to manage through this, and they've done that very, very nicely. Residential is another really category. Now, residential requires a good bit more sophistication for the individual investor. Obviously, you're investing in residential real estate. There's a lot more leverage that is associated with those types of transactions, which makes it more volatile for investors. Over time, equity REITs have always outperformed mortgage REITs. We've gone back over decades and comparing performance levels of residential mortgage to equity. We'll dial in and out of some of the residential names. Again, more yield enhancement, but you've got for the individual investor to really go in, you really have to know what you're doing. And it's almost a market timing business. Again, we're fundamental approach. So you really have to have kind of more of that market timing hat on. Although, residential, there could be some decent opportunities. One name we like, it's actually a commercial mortgage REIT, is a company called Broadmark, BRMK. We own shares in Broadmark as well, but they are a lender to single family and multifamily lenders. They pay about an 8.5% dividend yield and have zero debt on their balance sheet, which is pretty amazing. And that's a great company. I mean, obviously, they're really riding into this housing boom that we're seeing right now. And they've had very, very few defaults. I mean, we've really been watching this company closely through COVID. They've had some defaults they've had to work through, but not many. It's less than 1% or even less than half of 1%. So Broadmark's definitely a fairly new name to the REIT space that we like a lot. And again, that's a mortgage REIT, but they lend to the residential community.
How impactful do you think rising rates is going to be on the REIT sector going forward? We saw, the yield curve spike up a little bit in recent weeks. How much more does that have to rise before it's either helpful or is it harmful to REITs?
Sure. Well, first, let me address the fundamental side, then I'll address the technical side. So fundamentally, REITs are in great shape. They've actually had 10 years now coming out of the recession to stress test, to prepare for rising rates, to deleverage their balance sheets, to recycle their portfolios. In fact, a number of these REITs that we cover, it's interesting because they were so much more prepared for this pandemic. When you look at companies like Kimco Realty, they had spent most of 2017 and 18 and a large part of 19 recycling their balance sheet, improving their liquidity, reducing their amount of leverage, and really they're trying to get an A rating. They have a triple B plus rating, and so they spent 10 years, from the last recession, because they were forced in 2008 and 9 to cut the dividend substantially, and they learned their lesson, like many REITs did that existed in 2008 and 9. So we've already prepared for rising rates in terms of deleveraging. A lot of these companies have match funded their investment profile with their debt maturity. So a lot of these net lease REITs, they invest in properties that have like 10, 11-year leases, and they try to match fund that out. So those spreads are locked in. I don't care if rates are going up. Those investment spreads are locked in. So ultimately, a lot of those companies have tried to do that. Hotels obviously you can't match fund because they rent by the day. It's hard to do that. For the large part, the balance sheets across the whole spectrum, again, I covered that in my book, over the last 10 years. And actually, I want to give Ava Steiner a shout out. She actually is a professor at Penn State, formerly at Cornell. She wrote one of my debt chapters, and she's amazing. But she spent 10 years helping kind of analyze and research debt and the effects of debt and REITs. And what we found is REITs are in great shape. So rising rates, no problem whatsoever. And again, you got to go back to when rates increase, what does that tell you? The economies are getting stronger and the companies are going to pay more rent. So I think you'll be able to increase rent. Now, obviously retail, we're not going to see a lot of rent growth coming out of COVID, but certainly certain sectors, you can see those rents begin to rise as rates increase. So that's my fundamental spin. Technically, you're right. I mean, what happened is, and we've seen this now time and time again, where these effects on rising rates, I first saw it with Ben Bernanke in the taper tantrum. We saw these sell-off in the REIT space. I was like, what is this? Why are we getting sold off in rates? It's crazy. And so we'll probably see a sell-off. So guess what? That creates more of a buying opportunity. And we're always looking for that margin of safety. So technically, you're right, because REITs are always kind of in this crazy kind of paradigm where they're an equity. Are they bond? What are they? We all know they're an equity, but Mr. Market sometimes says, well, it's a bond and we're going to sell them off because, got rates rising. So technically, you're probably going to see some pressure, some sell off. And that's where we're sitting there trying to be prepared to buy that company when it goes on sale.
What is one long-term trend you see playing out over the next year or several years?
Well, I'll tell you, we just started covering prop tech. And I never, if you'd have told me a year ago, let alone 10 years ago, that I was going to be covering prop tech. I've got an analyst who's really into it heavy. But it's interesting. The reason I'm doing that is because a lot of the REITs are investing in prop tech.
And this is property technology? Is that just
property technology? Yes.
Okay.
Yeah. It's and there's a number of SPACs that have been created in the prop tech world. I was interviewing a CEO last week, Mike Shaw at Essex, which is a very large West Coast multifamily landlord. And he and some of his peers have invested in a prop tech, which is basically going to help innovate, leasing solutions and a variety of things to make their real estate platform, multifamily, more efficient, like signing leases virtually and a number of other things. There's an endless number of ideas that are surfacing in the property technology world. And I've seen these REITs going in and they're investing in these businesses. Simon Properties is also in that game. They're doing a SPAC. I don't know exactly what they're going to be investing in, but you're seeing a number of these companies that are really focusing on the technology aspects of real estate. So that's something that I think you have to be involved in. I didn't have a choice whether to start covering prop tech because that's what's going to drive performance. I'll tell you one sector that's interesting. It's kind of a sleepy little sector that you never really think about. And you drive by it every day, but it's self-storage. That's the business model that 10 years ago was, hey, Ed, pick up your yellow pages and you're going to, AAA storage and you're going to go rent from them. Well, now 10 years later, there's no yellow pages around in my office. So I'm going to go here. I'm going to find storage with my cell phone. And what's interesting is these big REITs, these big brands, if you will, that's what they are. Just like McDonald's and Burger King and Wendy's, you have, Public Storage, which is the big gorilla. You have Extra Space, Cube Smart, they're in about every town. Extra Space, I'll give them kind of the biggest shout out. They figured this out a long time ago. They said, yellow pages aren't going to exist. Let's get our traffic through the internet. And let's build a 24-hour customer service center to take care of customer service. You can see when you look at the investments they've made in technology, you can see why their earnings record has outperformed because they've done a much better job at technology. So to me, self-storage is almost kind of is really a tech play, and it's really a self-storage play. And that sector has held up pretty well with COVID, by the way. There was a number of months where people couldn't go out and lease space. So there was some pressure, when everybody was completely locked down. But obviously, self-storage is one of those, it's very sticky. I know when I put my daughter in a storage place, I couldn't get it out. It was impossible. I just kept paying the rent. It's hard to get out of these deals because it's just sitting there and you got to rent a truck. So it's a very sticky type of investment vehicle that lasts a long time. And again, these brands are forming now, creating that scale advantage that I alluded to earlier. And so those are the trends. I think technology is just really, I have to emphasize that's really critical.
All right. So we do a speed round called Trend or Fad. I throw out a few different topics and get your quick take on it. Opportunity zones, trend or fad?
Trend.
Cryptocurrency, trend or fad?
Oh my, that's going to be a tough. Is there another button? I'll say one or the other. I'll say fad.
Cannabis, trend or fad?
Trend, but banks are going to step in, creating more pressure on the cannabis REITs.
Buying houses on Zillow, trend or fad?
I'd say trend.
Brad, this has been great. What's the best way for people to find you and connect with you?
Well, I just cranked my Twitter back up. I came out of retirement on Twitter. And so that's the easy button. I haven't posted much, but at Brad Thomas on Twitter. I also have a website called bradtom.com, just a real easy name. And then, of course, if you want to go the longest is widemoatresearch.com is our website.
Brad, this is great. I really appreciate your insights and your time.
You bet. No, it's been a lot of fun, and look forward to doing it again.
Absolutely. And thank you for tuning in to another episode of Trends with Benefits.